This morning, we're gathered here at the NOLT Summit 2026, where we deepen conversations about leveling the play field for the underserved business leaders and giving them a head start.
This is the maiden edition of the NOLT Summit, but it will not be the last. Our ambition is to build this into an annual platform where the sharpest minds in the industry come together to think, to challenge, and to shape what comes next. So please lean in, engage, ask the hard questions. That is why we're all here. Welcome to the NOLT Summit. Let's begin.
What volatility does to your business case is it delays the time it takes for you to realize the expected performance.
What did the data say about Nigeria? And that is where it becomes interesting. And now coming back home so that we can look at how operating this geography, we can extract value from this volatility.
On the alternative energy side, honestly, there is a lot of activity going there. I can talk about DARS, I can talk about Mission 300. That space is no longer just the preserve or philanthropic or grant or impact funds.
I think that as this war continues, you're going to see more countries try and keep their currency within house and not buy USD assets or just reduce their reliance on dollar. But I don't think that's. There's a part of me that also doesn't think it happens in my lifetime where where dollar is not dominant because everything is priced in dollars and it's going to take a lot of shifts.
So the point I want to make is volatility is not risk. Risk is the risk of permanent capital employment. If you separate those two, I think you'll be able to approach risk management better.
NOLT Finance is a finance technology company that focuses on loans, investments, and financial advisory services. Today, we also mark 5 years. 5 years of expanding access, 5 years of empowering entrepreneurs, 5 years of bridging funding gap, 5 years of driving growth, intentional growth, and 5 years of unlocking opportunities. Once again, I'd like to welcome you officially to the NOLT Summit 2026. Distinguished guests, thought leaders, innovators, visionaries, ladies and gentlemen, it is said that empowering entrepreneurs is fueling innovation. Taking risks, yes, but bringing the vision to life. And it takes only a forward-thinking company or institution like NOLT Finance to know that. And that is why this morning we're gathered here at the NOLT Summit 2026, where we deepen conversations about leveling the play field for the underserved business leaders and giving them a head start. NOLT Finance is a finance technology company that focuses on loans, investments, and financial advisory services. And it operates as a licensed financial institution under the Central Bank of Nigeria. Today, we also mark 5 years. 5 years of expanding access, 5 years of empowering entrepreneurs, 5 years of bridging funding gap, 5 years of driving growth, intentional growth, and 5 years of unlocking opportunities. Ladies and gentlemen, this is the NOLT Finance Summit 2026, where we will be deepening conversations about funding, and not just for those who are able, for those who also lack the capacity so that we can level the playing field. Once again, I'd like to welcome you officially to the NOLT Summit 2026. And I'd like to say thank you for being here. Please give yourselves a resounding applause. To this effect, I'd like to quickly let you know that we will be having keynote addresses. We'll be having 2 powerful panel sessions, and we have our panelists and our speakers here. This is not just going to be a talk shop. This is where innovation is formed. This is where the vision is brought to life. So you're in for a ride. Distinguished guests, ladies and gentlemen, we will be proceeding now to the first agenda on the program, and that will be to have the executive welcome note. And I'd like to invite upstage 2 powerhouses. We will be taking the welcome note by the MD, CEO, and founder, NOLT Finance in person, of Mr. Babatunde Dada. And coming along with him would be the board chairman of NOLT Finance, Dr. Olushola Adedoyin Alao. Please, a resounding applause as they come up stage.
Sorry, the board chairperson is a lady, not a chairman. Thank you. Good morning, everyone. when we first started the discussions around having an anniversary event, some overzealous members of staff said, let's throw a big party to commensurate this event. Let's have good music, good food, and a great time. But one particular person in the name of Robert Ijure, our ED and co-founder, was like, at that budget, and he looked at me and was like, we better learn something. So we decided to have such an event as we're having today, something that is where people can come, have discussions, meaningful discussions. So here we are today. There are no balloons, but a room full of great people who can actually explain what's happening in the world and how it affects Nigeria. And I think Robert made the right call. But on a serious note, I'd like to thank everyone. It's a Thursday morning. You all have businesses to run, places to be, but you chose to come here to be with us, and that means a great deal to us. Distinguished guests, industry leaders, friends, welcome to the maiden edition of the NOLT Summit, the first of many. 5 years ago, NOLT Finance was established with a clear mission: to serve the underserved. We're a CBN licensed company built on 3 business pillars: investment, credit, and financial advisory. In 5 years, we've disbursed over 26 billion naira in loans, and our customers have entrusted us with their funds. Every one of those numbers represents someone who said, I trust you with my money. We do not take that lightly. This summit is how we choose to mark that milestone, not a celebration of ourselves, but an investment in a conversation the industry genuinely needs.
Thank you, Babs. Good morning, everybody. You're very welcome. We are not living in ordinary times. Trade policies are reshaping overnight. Mr. Trump has made sure that the last 18 years have been anything predictable. Tensions in the Middle East continue to ripple through energy and commodity markets. And here at home, we are navigating inflation, currency volatility, a rich capitalizing banking sector, and millions of Nigerians trying to preserve the value of what they have currently earned. It is precisely in moments like this that conversation like we're about to have matter most. The answers we need will not come from any single institution or any single perspective. They will come from exactly this: the best minds in the world, thinking together, challenging each other, and living sharper than ever. That is why our team is from volatility to value, strategic finance in uncertain times. Dr. Biono Adedigbe is one of the most respected economics, a first-class mind in every sense of the word, with over 44 years experience spanning academia, investment banking, public policy, and advisory at the highest level of government, including serving as senior economic advisor to the president on financial sector development. When we ask ourselves who in this country would walk into a room of this caliber and make every person in it think differently about what comes next, there was only one answer. If anybody can make sense of where we are and where we're headed, it is him. Following the keynote, a panel of truly distinguished practitioners, leaders who navigate this market every day, will take the conversation forward. I promise you it will be worth your attention.
And one last thing. This is the maiden edition of the NOLT Summit, but it will not be the last. Our ambition is to build this into an annual platform where the sharpest minds in the industry come together to think, to challenge, and to shape what comes next. So please lean in, engage, ask the hard questions. That is why we're all here. Welcome to the NOLT Summit. Let's begin. Thank you very much.
A very
very big thank you to the Managing Director, Chief Executive Officer and Founder, NOLT Finance, Mr. Babatunde Dada, and the Board Chairperson, NOLT Finance, Dr. Olushola Adedoyin Alao. They said, and I'll just like to paraphrase that, how I framed it was the solution to volatility is empowerment. And in the words of Dr. Olushola Adedoyin Alao, she said the answers we need will come from the best minds in the room, which are already here, thinking together, empowering each other. And this reinforces the theme from volatility to value, strategic finance in uncertain times. And like you've heard, the event is officially open. Ladies and gentlemen, we will now be taking the keynote address, as was mentioned, and the keynote address will be given by a power force, one of Nigeria's most distinguished economists, a rare combination of academic rigor, deep institutional knowledge, and real-world policy impact built over more than 4 decades at the highest levels of banking, consulting, and national economic governance. He holds a first-class degree in economics from Obafemi Awolowo University, 1980, graduating with honors and a PhD in economics, specializing in corporate finance from the University of Lagos in 1989, during which he was awarded the prestigious Sir Adam Thompson Scholarship as a visiting doctoral student at the University of Sussex, the UK. His career trajectory is a masterclass in purposeful progression from academia at the University of Lagos through senior roles at the World Bank, International Merchant Bank, and First City Monument Bank, to the founding of B. Adedipe Associates Limited, BAA Consult, in 1993, a firm that has since become one of Nigeria's foremost financial and management advisory institutions, serving governments, regulators, banks, and corporates alike. He is also a regular commentator on CNBC Africa and a widely quoted authority on Nigeria's macroeconomic trajectory. He is a fellow of the Chartered Institute of Directors Nigeria, where he serves as a council member, a fellow and a chairman of the Strategy and Advocacy Committee of the Chartered Institute of Bankers of Nigeria, a life member of the Nigerian Economic Society, and a member of the American Economic Association and the Lagos Chamber of Commerce and Industry. He currently serves as Professor of Practice at James Hope University and sits on the boards of several profit-seeking and not-for-profit organizations in capacities as chairman, independent director, and non-executive director. Dr. Adedipe brings to this summit a rare 360-degree perspective: economist, banker, strategist, and policy architect, making him uniquely placed to illuminate the path from volatility to value. Ladies and gentlemen, please join me with a thunderous applause as I make welcome the keynote address speaker, Dr. Abiodun Adedipe, founder and chief consultant, BAA Consult, and also a professor of practice, James Hope University. I think you can do better than that.
A very good morning to you all, distinguished ladies and gentlemen. And let me start on the note of expressing my deep appreciation to NOLT Finance, which is entirely the leadership I've had my path cross theirs over many years. In fact, when the MD and ED came to my office and had in charge of this event, we began to look at how our paths had crossed over time, and of course, let me say the families, okay? And of course, as our chairperson said earlier on, while she married the bank some 20-something years ago, our paths also crossed. So I can only say thank you so very much for having me stand before this august audience. And I'm also aware that I have limited time for this keynote address. So what I'm going to do is to speak to the high points of my slide deck, which I believe very strongly NOLT Finance will make available to all the attendees. So now, the theme of this summit is from volatility to value, strategic finance in uncertain times. So I chose to approach it this way first to get a high level understanding of what volatility to value means. And it is simply what we call a strategic process. And I always like emphasizing the word process. Because once you talk about process, it means there is a beginning to it, and there's also an end, and there's what we call process output. So which means this summit is designed to achieve something at the end of our conversations today, which we also carry forward in terms of our interaction with the world in which we play. But this time around, we say it's a strategic process of converting uncertainty, and also like making a distinction between uncertainty and risk, and make it very simple. So now, the simple difference between risk and uncertainty in my opinion is this. Risk is measurable uncertainty, which means uncertainty is pervasive, it's everywhere. Okay? You can convert an uncertain situation to risk by looking at how to measure it, and then that evaluation will guide you to taking positions. Which is the whole essence of this summit anyway. So then equally, there can be rapid change. I mean, we can have it more, rapid than what our chairperson said earlier on, making reference to Trump 2.0 as significantly different from Trump 1.0. If I did something overnight and I saw this morning, the man went on his Truth Social handle and posted out that as long as he is still there as president, that the US will continue to ensure Iran doesn't go beyond where the blockade will continue until further notice. And immediately they sent that out overnight. The price of crude oil went up everywhere. In fact, Brent jumped up by 7%, thereabout. And so that gives you also an idea of the environment where we operate. And there are fluctuations into actionable opportunities. But that is one line I always tell people that look. Now, most people, when they see troubles and challenges, they pay too much attention to those challenges, and therefore their energy gets drained. But when you look at situations where people talk about troubles, then you train your mind, that's the way I put it, a mind that is trained to see opportunities will never succumb to or complain about problems. So the conversation today, therefore, is all about opportunities that generate measurable advantages, whether in finance, business, or investments. Now, within this month, since this month started, this will be like the third major presentation I've made in issues touching across this. Of course, I've made more than 10 this month. Okay? But I picked out 3. This is the third of them. The first one was about looking at the current disruptions globally triggered by February 28, 2026, and then coming to what company directors should do when you are leading organizations in an environment like this topsy-turvy. And now today we are talking about how to extract value from volatility. So then I took my mind back to some 6 years ago, when in March 2020, the World Health Organization announced COVID-19 as a pandemic, meaning a health crisis. And of course, it began with all manner of analysis. But that taught me a lesson. When I was invited to speak to them at NBIC webinar, I thought it was just Nigeria. I got on the webinar and there were 54 countries there, including FDIC, that's the Canada Manufacturing NBIC in the US. Canada was there, Australia, many European countries in Africa, 54 of them. But that taught me a lesson. That when we are in a crisis, nobody is an expert. And that is why what NOLT Finance is doing today is very significant. Bringing experts variously to come and dimension the issue of volatility to value. So we came up with the acronym VUCA. Now we are in an environment of volatility, uncertainty, complexity, and ambiguity. So everyone began to talk about that acronym. VUCA war. Then we had a question that the day calls up. And we said, if VUCA is the new normal, then what would the next normal look like? We began to talk about the next normal. But ladies and gentlemen, we have entered the next normal. In fact, we entered into 2025. That goes to the acronym BANI. BANI representing brittle, anxious, non-linear, and incomprehensible. I pick out the non-linear there. Non-linear means in 2025, your company performed exceptionally well. Then if what you did in 2025 that produce that result, repeat it this year, you won't get any result close to that. So it means a non-linear environment means you must continually interrogate what is happening around you and also be innovative in the strategic initiatives that you adopt. Now, making it more interesting, I also came across this recently by the author of Rich Dad, Poor Dad, and that is Robert, Kiyosaki. He said, for every benefit, there is a risk. And for every risk, there is an opportunity. And so, in now bringing this in context, I said there are some things we need to pay attention to. Now, if you talk about equities are driven, that is, their values, prices are driven by projections of what we expect as future earnings. That's what we bring. So that's what determines whether we invest in it or not. The promise of future earnings. But when it comes to bonds, it's likely about current cash flows, nominal cash flows as we call them. But there's an interesting thing when it comes to portfolio management. We always play between equities and bonds, or commonly we say fixed income securities. We play around that. We say, okay, I'll build a portfolio that carries both, in relative percentage, depending on what the market is saying. And of course, taking also the cue for what happened in March 2023. That was when Silicon Valley Bank collapsed. Now, it took only a matter of 48 hours between the Wednesday and the Friday. Now, what was the problem with Silicon Valley Bank? That was a time that Central Reserve Banks were responding to COVID-19 disruption. And so many of them went accommodating. To be accommodating means they reduced the policy rates to very low levels, following what Japan did for the first time in the world in the year 2000, when Bank of Japan adopted monetary policy rate of 0%. That was the first time it happened. So, of course, we tested negative interest rates like the rest of them. Now, Silicon Valley Bank observed that interest rates were now very low. But unfortunately for it, it was heavy on deposit side, being a bank that focused on startups. So it had a deposit book of about $185 billion. But its loan book was very small, less than $50 billion. So that difference between the loan book and deposit book is invested massively in bonds. So when normalization began, that is, the Federal Reserve started raising the policy rate, bond prices, and of course the yield began to take a different turn. So that opened a gap in the book of Silicon Valley Bank. So the bank now went out to the equities market to raise fresh capital of $5 billion. Everything was going well. Book building, successful. Then at a point, the outgoing chairman of Fed, made a media remark and said, the way inflation in the US is behaving now, we are not likely to begin rate cuts. We still likely keep rates up there. And so two of the PEs, private equities, that were part of the book building, now said, wait a minute, if the Fed is going to either increase the rate further to fight inflation, that means bond, in terms of yield, we go further down. Then the gap in the book of SVP will become bigger. So the $5 billion they are trying to raise will not be enough to bring that home. So, my friend, I'm not going to risk my investors' money in that stuff. So two of them withdrew, but their conversation linked to another person who unfortunately put it on social media. And so they do spread. So within 48 hours, the book didn't collapse. And so FDIC walked in on Friday, and that was the end of SVP. Then what did we take out from that? And that's the lesson for us. In interpreting that, I said, if SVP collapsed within 48 hours, because some information on his book building got on social media, then we should coin something that will add to our risk register and call it social media risk. So it means every corporate entity should now be conscious of social media risk. Now, if stock prices are driven by future earnings and bonds are driven by nominal cash flows, what then in the place of geopolitical stress, which of course is what we are seeing in the Gulf states currently. And of course, we know that can test the relationship between equities and physical security. The resilience can be built into the portfolio by adding commodities, according to Greg Lee, the director of investment at Parametric. Now, commodity prices are driven by two things. One, disruptions. Anytime there is disruption in the market, whatever commodities market is disrupted, the price of that commodity will start going up, right? The second is what we call the real economic demand for that commodity, which of course is what has sustained crude oil as an important source of energy. We call it dirty fuel. So the question now is there a possibility of building resilience into your portfolio by going beyond equities and physical securities, and probably now bringing into that also commodities? In fact, when I looked at that this morning, I added a slide of that to my slide there. But also my mind went back to Lagos Commodities and Futures Exchange. And of course, my company played a role in bringing it into reality. We did the information memo and guided the process, did the business plan, and today we are very happy to be a part of Lagos Commodities and Futures Exchange. Now, involving global macroeconomic and social issues. As of today, the central common challenge that the world is facing is what I describe as the USA-Israeli war on Iran. Notice I didn't say with, I said on. Alright? Because that was the kind of thing that happened when Russia invaded Ukraine in February 2022. So different appellations. First they said, oh, the Russia-Ukrainian war. I said, that's not correct. Somebody said, well, Russian invasion of Ukraine. I said, no, that doesn't describe it well. Then the journalist now came and said, we can describe it as Russian war on Ukraine. I said, that's not like it. And of course, I won't go too far with that because of time. Then at this instance, today is the 62nd day of the Gulf conflict. Okay, that began on February 28th. And there is no clear indication yet as to when this conflict will end. Then the narratives have been shifting, very interesting. We won on that war. Trump went on through social and he said, we won. Then we too, he went on the same media and wrote, we are winning. Then we three, he came out again and said, we did it. So, and now, they asked him, what is the position now? He said, I don't know. But of course, use that to illustrate the kind of world we operate in. When a man sits on the largest economy in the world by GDP, okay, and also a country that is acknowledged to be, number one military power in the world, and the man sits on that is demonstrating such erratic, semi-erratic signals, let me put it that way, to the world we live in, then that becomes a major challenge. Now, since 2021, our firm has been tracking major disruptions in the business world globally. And of course, we keep updating that on an ongoing basis. I won't speak into them, but they are all there in 2 slides summarized. So I will go to this slide that you see on the screen, a very interesting one. I developed this only yesterday morning in speaking to some directors on business disruptions and how to interpret that. This actually came in interpreting the Gulf conflict vis-a-vis Nigeria and every other country in the world. Now, if you look at this particular quadrant, what it shows is at the top, resilience, and at the bottom, vulnerability. So now, the quadrant shows that if you have strong buffer and you are independent of the disrupted market, then we say you are resilient. But your country, that's the geographic question, or your entity will be non-resilient if you are independent, which is good, but you have very weak buffers. And of course, the other half now says if you have strong buffers, but you are dependent, that's why you find Japan, for example. Japan dependent on 90% of energy imports, okay, in terms of dependence. And of course, you see South Korea, 70% dependence. They come to India, about 60-something%. So the difference between them now is dependence in terms of importation of crude oil or refined petroleum products or LNG or in fact fertilizer. Those are the 4 elements disrupted by this Gulf War. Okay? So if you have strong buffers, then you are dependent, that is high risk. Then the highest risk of all is when you are dependent and your buffers are weak. Interestingly, Nigeria fell in the green quadrant there because of our strong external reserves which was over 12 months cover of our monthly import bill. In fact, both Egypt and I think South Korea were record to have strong buffers, but their own cover is just 7 months. At the time this was done at the beginning of this month. Okay? So the critical thing is the next slide, and that is talking about having established, looking at these 4 windows, where does your own company or organization belong? Where do you belong? So once you establish where organization falls, the question will be, what is the extent of your vulnerability? Then, can you also identify and evaluate the options that you have? That is how to now begin to move from that disruption, that volatility. How do I extract value from what we are seeing here? And of course, you choose the best of the options, not minding the inconvenience or discomfort that you are looking at them and say outcome. So the pathway, which was a model that our friend developed in 2021, was that there are 3 pillars when there is volatility or disruption in the market. The first pillar is what are the initiatives we adopt in order to survive that disruption. That's the first pillar. Second pillar, having survived, how do we then stabilize? What are the things to do to stabilize? The third one now will be how do we restart growth? Okay? Because of time, I won't tell you the story of what DA did to survive the disruption of 2021. Because that was the time I told my colleagues, tell me what kind of business are we in? Are we in essential or non-essential? They were looking at me. I said, well, when you are all locked down at home, what do people need? They said, well, food. I said, correct. They what do they need? They said, healthcare. I said, correct. Okay? Maybe if you're also involved in logistics, that will bring the food and things people need to your home. Alright, so those businesses, therefore, in those sectors will be essential under that particular disruption caused by health crisis. Alright? I said, but anyone whose business is not there will be tagged as non-essential. So I now come back and say, okay, where are we? DA comes up. My colleagues now said, we are non-essential. I said, so we have to think about how to survive. How do we survive? I said, okay, let me come up with an idea here. Let's go check our audited accounts for 2018-2019. Which entities gave us business? If we have analyzed COVID-19 impact on economies and did a pro bono, document that we send to business to help Nigeria, can we offer this to our own clients too? But when we do this for corporate entities, profit seeking, what we add is this: we do it for them for free. My colleague said, do it for free. How do we survive there? I said, wait, we are talking of debt neck hanging on your neck. We are talking about making money. The first is to survive, not to make money. I said, okay, you know what we do? Do emails to all these clients that gave us business 2018-2019 that we do this dimension for them for free, and also give them ideas on how to survive, how to stabilize, and restart growth. First response came from First Bank. First Bank said, we want you to, it's free now, free webinar. Okay, the Bank of Industry, take next. Then we got feedback from MTN, we got feedback from Resta FedEx, and so on and so forth. So when we did that of First Bank, and that was where I got interested. When we finished that of First Bank, the MD of one of the subsidiaries of First Bank, who was there at the webinar, now called me and said, please, can you do the same thing for the subsidiary that I lead, but we pay me a fee? I told him, I said, can you see? We did it for free for First Bank, but the subsidiary of First Bank want the same thing now, that is going to pay us. I said, that is how we transit from survivor to now stabilize. Okay? So that is what my focus is on for the rest of my presentation. So now, what are the global high points? Now, last week I was invited to take a look at the Nigerian stock market. That was by the CIS Academy, Director of Stockbrokers Academy. And now talk about consolidation. Now, is there any indication that the Nigerian stock market has gone into a plateau where you now ask whether the market was going to now go on a downturn or to continue to move upward? That's what consolidation is about. So now in interrogating that, I did a few things. Now, global disinflation, and that's the reality as of today. I checked the data only yesterday. Okay? Has continued in January and February up until the breakout of the US-Israel war on Iran. That triggered inflationary pressures, as mentioned earlier by our chairperson. Inflation rate ticked up in March. Alright? And I gave illustration of the top 5 economies in the world plus UK. For USA, inflation ticked up from 2.4 to 3.3% in March. Now for China, China was the outlier. China inflation dropped from 1.3 to 1.0. Then Germany from 1.9 to 2.7. Japan from 1.3 to 1.4. India from 3.21 to 3.4%. UK, of course, not one of the top 5. They're also important for us to make reference to, from 3 to 3.3%. Now, most central reserve banks decided to hold policy rates, all right, being cautious and watching the inflation trends. If you also notice, many of them are reluctant to return to rate cutting. There's also the impact of global economic growth in 2026 expected. Of course, in the April outlook by the World Bank and IMF, that is what we do. We also do outlook in our Fed. We've been doing that now for at least since 1997. We've been doing annual outlook for the Nigerian economy. So, but from the outlook issued last week by both the World Bank and IMF, there's an expectation that the global economic growth will also dampen this year from 3.3% or 3.4% to 3.1%. Now, what did the data say about Nigeria? And that is where it becomes interesting. We are now coming back home so that we can look at how, operating this geography, we can extract value from this volatility. Now, if you look at our stock market, very interesting environment there. What I did in the table, that's the next slide, to the one you showed earlier. What I did there was to compile a table, next slide, that shows what happened in our stock market between December 2022 up until yesterday, close of the market. Now, if you look at 2022, we ended at 90.98% year-to-date return. As at May 2023, before President Tinubu was, how do I put it now? Before he was sworn into office, let me put it that way. Because I'm not a politician, I'm a simple analyst. So I don't want anything I say to be misinterpreted. I stay with data. Alright, like a friend of mine will say, friend, how are you? He said, for everything, I trust God. Then anything other than that, if it is about human beings, I will trust data. So what did the data say? And that's what we see here. Alright? As at close of business yesterday, year-to-date return on our stock market was 52.43%. Already ahead of what we achieved the whole of 2025, which was ended at 51.19%. So now, I also need something, and this is a carryover from what I did for CIS last week. I said, let's go back to the story behind Vision 2020 of Nigeria. I was there at the beginning. But the idea was that of Professor Soludo. He didn't come from President Obasanjo, because I was there. Okay? He saw this publication by Goldman Sachs that said Nigeria had begun reforms, okay, and that the way Nigeria was going, there was a likelihood that the Nigerian economy and stock market will begin to behave like what they saw with Brazil, Russia, India, and China, the original BRICS. Which Goldman Sachs in the year 2001 did an article on and said those 4 countries and markets will be the new building blocks for the global economy over the first half century of the new millennium. That was between 2001 and 2050. And so identify those 4 markets. 4 years after 2004, those markets have produced opportunities for investors. That's international investors. They made a lot of money. So some people went back to Goldman Sachs. Can you look at this economic model again and give us an idea of which countries can produce opportunities where international investors can also make money? So that was what gave birth to the next 11. The next 11 happened to also include Nigeria. So it was in response to that, Soludo now said, if we are part of next 11, let's look at it this way. We have the G7, then we have the BRICS, 4 of them original, making 11. And then the next 11, according to Goldman Sachs, that's where Nigeria is, that will make 22. So why should we be the last among next 11? Let's say to be number 9 at the worst among next 11. That was how I came up with the idea. of being number 20. Okay, they will now coin the idea of coming with a financial sector strategy for year 2020. Our company led the credit market team, and the idea was that we use credit to drive the growth of the Nigerian economy to $963 billion GDP by year 2020. That was what we had then as a vision. So now, when you look at all that, and I'll say, okay, this time around, let me go back to the bridge, the original form. How did their stock markets grow? Okay, the Brazilian Bovespa index turned in 73% growth over the 4 years, from 2001, I mean 2001 years to 2004. Then the Russian points grew by 1.3%, Indian National Stock Exchange 65%. And I said, okay, if this was the way their stock market behaved, how about Nigeria's stock market? Let's take it from May 2023 up until date. What can we reckon there? 325.33% growth in the index. And then market caps, equities only, 402.95%. That is massive, which means we are in an environment where both the economy and the stock market are behaving stronger than what we saw with BRICS. And now make South Africa to go and appeal to Goldman Sachs. Please, that small letter S behind BRIC, the original, convert it to big letter. Then let's call it BRICS, making now 5 countries instead of 4. Okay? Then if you look at where we are today, and I will go quickly now toward the end of my presentation. Now, if your investment portfolio in Nigeria mimic the market in 2025, that means you have made a 51.2% return in 2025. Now, if a similar thing occurred this year, as at close of business yesterday, you should have also made 52.43% return. Now, I will skip a number of slides here, but what I did there is I created a particular slide, I call it macroeconomic dashboard. That was about 4 years ago. So I'll update that on a daily basis. What I did in this slide we get is where the dashboard took us to end of 24, where we were end of 25, and where we were end of business yesterday. So we get all those details. So I will go to the final part of my speech, and that is now to speak to specifics. How do we extract value in real terms? And of course, I will skip economic outlook, you can get that also. We're talking about strategic choices in turbulent financial market. So what do you do? Number one is you don't do forecasting in a turbulent environment. What you do is scenario planning. And that means you have minimum of 3 scenarios. Okay? Best case, worst case, most likely. And then under each of them, how will what initiatives will I adopt if any of this becomes reality? That's also a term of cash is key. You don't acquire, long-term assets just because you see a need for them. They have to be proper prioritized. But let me make it more interesting and skip that. You can always read that up. What we say, the generic choices people make. You want to diversify portfolio, that's a textbook, recommendation. Generally, not even to talk about volatility now. You rebalance your portfolio. You take a long-term perspective. You also do research and analysis. That's why I was excited when I saw people here this morning. Okay? Of course, you talk about stop loss and risk limits. But what now is more interesting as I try now to conclude, because I see blessings coming closer and closer. Alright? So I'm sensitive to that. But these are called tactical issues. Now, illustration. Let's assume January 2025. You had 10 million naira to invest. And at the end of the year, you gained 52%. So your portfolio is now valued 15.2 million naira. So how do you deal with this in such environment? We say you can take profit of 25%, that is of the portfolio. That profit will give you 3.8 million naira. You can do a rebalancing by taking 20% of that to invest in bonds, right? Which means you are moving from 100% equities to now 20% bond. You take some profit, and then of course you hedge the remaining position. Place a trailing stop loss at 10% below current market value. So they have affected all the things I mentioned earlier, although I didn't say them now because of time, that are in what I call the tactical moves. Then now it gets more interesting. This is the reality using actual data as at yesterday evening. If you were in the market between February 28, 2026 and 31st of March 2026, now the Gulf conflict must have dampened your portfolio if all it had were equities and bonds by 3.6%. The value must have dampened. That is real life data now. Okay? If your portfolio consists of only equities and bonds between when the war began and end of March 31st, you would have lost 3.6% of the value. Then if you went the way of how do I extract value from this volatility, and you recognize that disruptions come, that of 2022 with the Russian war on Ukraine disrupted the grace market. All right? So at that time, the price of wheat went up significantly. Okay, but this time around, the destruction is in the Middle East. So the commodity affected is crude oil primarily. As I said earlier on, also LNG, then refined petroleum products, as well as fertilizer. Those four elements, very strong in terms of the volume they represent, 20 to 30%, depending on which one. So now, if you had just 5% of your portfolio in commodities, and commodities can include, crude oil, gold, copper, maybe corn, and any of these agricultural products, you have just 5%. If only 5% of your portfolio was in commodities, the data process showed that as at the end of March 31st, you would have gained 1%. Instead of a loss of 3.6%, your portfolio was made up only of equities and bonds. That is now based on hard facts and figures. Okay? To illustrate the fact that if you want to extract value from your portfolio during volatility, you must go beyond the traditional thinking of trading between equities and fixed income securities, and also consider what is the trigger of that disruption. What commodity is the trigger? You have also that in your portfolio. So in closing, I will put it this way, does your organization have a bridge strong enough to withstand the turbulence? That means design, maintenance, and ability of the bridge, and that is what resilience and sustainability is all about. So it goes, everything is going to be fine in the end. Full stop. If it is not fine, then it is not the end. Thank you very much.
I think that for that very powerful keynote address, we need to give another round of applause. A very big thank you to Dr. Abiodun Adedipe, the founder and chief consultant, BAA Consult, professor of practice, James Hope University. Distinguished guests, ladies and gentlemen, we would like to now proceed to the next item on the agenda, which is the first powerful panel session. We will be having this panel session with powerhouses that we have brought together this morning to discuss some of these pivotal concerns about financing the underserved business leaders, the underserved ecosystem, and we have amazing panelists in the house that will help us do justice to that conversation. So without further ado, I would like to first bring up the moderator, who will then do the honors of bringing up the panelists. Ladies and gentlemen, I'd like to bring up stage one of Nigeria's most accomplished legal and financial minds, the Harvard-trained partner at Banwo and Ighodalo, where she heads the firm's banking and finance practice, and has spent over 18 years at the forefront of high-stakes corporate finance, M&A, and financial regulation. She currently serves as a director at Fate Foundation, Ocean Wings Hospitality Limited, Calabash Technology Solutions, and Amel Finance, demonstrating a commitment to value creation across the private sector, technology, and the broader development ecosystem. She also serves on the Presidential Petroleum Reform and Value Optimization Task Force, where she contributes to shaping the policy architecture of Nigeria's energy sector. She is a member of the Nigerian Bar Association, the American Bar Association, the New York Bar Association, I think that deserves a round of applause, and the Loan Market Association, an international footprint that speaks to the global standard she holds to herself. She was recognized in the ESQ 40 Under 40 Nigerian Rising Star Awards 2019 and is a legal 500 recommended lawyer. As a panel anchor for today's session, she brings not only her intellectual sharpness and cross-sector experience, but also the kind of ground, the kind of strategic thinking, and transforms a discussion into a genuinely illuminating conversation. Distinguished guests, ladies and gentlemen, please join me with a resounding applause as I make welcome partner and head of banking and finance practice, Banwo and Ighodalo, Seyi Bella.
Good morning, everyone. Thank you so much for that bio and that introduction. Sometimes they read your bio and I'm like, oh my gosh, I should have sent mine. Thank you so much. And let me welcome everyone once again to the maiden edition of the NOLT Summit. We're so glad that you could be here with us. Dr. Biola Adeniran has done such a fantastic job this morning. He's set the right tone for us. He's told us he's put the best global economic framing as regards our conversations today about from volatility to value, strategic finance in uncertain times. I'm just going to go right straight to it, and I'm going to invite my esteemed panelists for panel session 1. And so, just give me a sec while I read their names out. So first, I'd like to introduce Rolake Akikube-Filani. She's the CEO, Energy Inc. Advisor. She's a global financial finance and strategic communications leader. Yes, please. She's a bilingual C-suite executive with over 17 years, spanning energy infrastructure and capital markets. Rolake is one of Africa's most recognized voices in energy finance. She has held senior roles of Evian Quest, EcoBank Group, and Mixter Africa, and served as lead architect of a landmark 2024 Nigerian banking capital raise. A regular analyst on CNBC, Bloomberg, BBC, and CNN, she holds degrees from the London School of Economics and a joint MBA from the Triumph Alliance, LSE, HEC Paris, NYU STEM. Please give Rolake a resounding applause. Thank you very much. My second panelist is Dr. Muyiwa Oni. He's the regional head of equity research for South Africa of the Standard Bank Group. He's a top-rated equity research analyst with over 19 years of sell-side experience. Dr. Oni leads West African equity research strategy at Standard Bank Group for a global base of frontier markets investors. His coverage spans equity strategy, financials, building materials, and oil and gas. He holds a PhD in finance from Pan Atlantic University and is recognized by the Financial Mail as one of Africa's foremost market analysts. Please, let's give Dr. Muyiwa Oni a resounding applause. Thank you. And my final panelist on this panel session is Arnold W. Green. He's the CEO and Managing Director for Renaissance Capital Africa, RC Asset Management. Arnold leads one of Africa's most respected investment banking and asset management platforms, part of the global Renaissance Capital Group, operating across 50 plus markets with over 17 years across developed, emerging, and frontier markets. He has led senior roles at Produce Asset Management, EcoBank, EDC, and African Alliance. He holds a derivatives qualification from the Chartered Institute for Securities and Investment, CISI. Can we please give Arnold a resounding applause? So let's get right into it. We have our esteemed panelists who are subject matter experts, and they're going to be providing their own views generally on how to stay resilient in this time where there's volatility and how we extract volatility or how we extract value from volatility. I'm going to ask, I don't know, I'm going to start with you first. And the first question I'm going to ask you basically is, I'm going to start to look at our currency. Everybody knows that currency stability is a big indicator of macroeconomic stability and of course investor confidence. And so the first question I'm going to ask you is, over the last few years, Nigeria has suffered currency instability leading to inflation, reduced purchasing power and uncertainty for businesses and investors. And so the question is, should Nigerian finance leaders treat currency volatility as a strategic opportunity rather than just a risk to contain?
Thank you for the question. Can anyone hear me? Okay. I think I'd like to say both, right? So it's an opportunity and I guess risk, but it also depends on who you are, right? So if you're a speculator, it's a wonderful opportunity. You're speculating, looking for the DYDX, right? You want the volatility, you want that there's arbitrage, or you want to buy low, sell high, buy low. But if you're a foreign investor, you want the carry trade, right? So currency is cheap or not acting properly, but the local assets are giving you higher yields. But now if you're a business, I can see how that's a risk, right? Especially if you're a business that has, you have US bills, your revenues in Naira. It's now your job now to figure out how to navigate around this risk. And one of the best ways to do is to figure out how to structure engines for yourself. So the short answer to your question is yes, it's both risk to sort of navigate around.
So it just depends on who's
and it
looking at it.
depends on who you are. Yes.
Yeah. Thank you very much. I think the next question will then be for Muiwa. And the question I'd like to ask you is still looking a little bit at currency. So we see when a currency like Nigeria is losing value, currency like the Naira is losing value, company revenues and profits may look higher in nominal terms, but that increase might just be due to, of course, inflation or currency depreciation, not real business growth. So the question is, how do analysts figure out what parts of a company's performance is real versus just inflated by a weakening currency? And how does that affect capital allocation or where investors choose to put their money?
Well, thank you for the question, Sean. I'm happy to be on the panel. I think it's an interesting question, and it's something we had to live through over the past couple of years, particularly with the very volatile currency. And I'll say, if one is looking at it, you have to look at it in two parts. So there are clearly businesses that have modeled or adjusted their balance sheet in such a way that they benefit from this one-off issues. And so even while you are trying to model the business, for example, you have to, one, understand that there's a limit to how much one will continue to see this steady devaluation or movement in the currency. So if you look at the bank, for example, one had periods where banks had very long open positions, so they were holding dollars beyond the regulatory limit, and the regulator allowed them because there was a benefit to holding that. And one saw material foreign currency gains that at some point the taxman came after, but they were unrealized as well. And so in such cases, while modeling the business, first understanding that it's a one-off and you can't model it as a going concern. So I guess there's nothing wrong with taking the advantage where you can, but also understanding that going forward, some of these seemingly gains could turn around to become losses. So if you look at the same banks, for example, looking at their balance sheet and P&L last year, one saw foreign currency losses. And then if you're looking at businesses that are on the other side, so we had telecom companies, consumer companies as well, that had foreign currency loans. And so because of the depreciation of the currency, they ended up with foreign currency losses that had negative impact on their businesses. And as soon as the situation reversed, one has started seeing more steady profitability and steady growth in their business. So I think it's understanding the cycles and also modeling that and in your allocation as well, trying to take advantage of these periods and knowing how quickly to roll out of it when the situation stabilizes or reverses.
Thank you very much. And that's why therefore means that you pay attention to data, pay attention to everything that's happening basically around you, and not look at the numbers in Naira and think that you're doing fantastic and doing very well. You probably should also look at how well you're doing in USD as well, and take a look at that to be able to determine whether you're really, really, really doing well, particularly when you're dealing in a currency that's losing value. Thank you very much for that perspective, Rima. US-Israeli war on Iran. For clarifying that, I don't think that there's anybody in this room who doesn't now know about the Strait of Hormuz. Yeah. Many of us didn't know what that was, but we have all learned what that is in the last couple of weeks. So yes, we saw that US and Israel launched airstrikes on Iran. And of course, we've seen how that itself has affected the global economy. Many people say that because crude prices are increasing, that is good for us. And so the question to ask is, rising crude prices that are driven by geopolitical conflicts, it looks like good news for us in Nigeria. But is that only on paper? Is that good news for us in terms of rising crude oil prices? And then if it is, the question is, how do our indigenous energy companies actually capture that upside to the extent that there is an upside for us in Nigeria?
Okay, thank you very much. Good morning, everyone. Good to see you, Shane, Wiwa, and Arnold, the gold man. Hopefully we'll be chatting about that. But good morning, everyone. So great to be here. Everybody's been asked that question so many times. I'll sort of start with the simple, obvious answers. So yes, on paper, we should capture that windfall. But the prospect of that windfall is happening in a context where we haven't really built the structural tools to effectively capture it. So if you take your mind back to when we set up the excess crude account, what happened to that? We're told probably the balance in that is maybe somewhere around $100,000. So go figure, right? Whereas other countries that have the structural tools have been able to capture that effectively. Now there are additional tools that the government is looking at to try and capture that. But the second point, one which has been talked about, is really about the level of production that allows us to capture that tool. So in the last 2 years, production did increase by maybe about 300,000 barrels a day, right? At one point in February, March, we had fallen to about 1.3 million barrels a day against a budget target of 1.8 million barrels a day. So you can already see that we're about 500,000 barrels short of the anchor for that windfall. So that's a problem. The third thing is really what we've done in terms of our sovereign financing structure, particularly with NNPC. So one of the ways NNPC collateralized its borrowings from financiers was to forward sell crude cargoes, right? And so the question is, what is the extent of that financing? What is the extent, the quantum of barrels that have been forward sold, and what is left, right? Good. Yeah, and in terms of our current production, how much of that is still going into that finance structure? So these are some of the things that have prevented us from capturing that full windfall. And it's interesting because although we set a budget benchmark of about $65 a barrel, the National Assembly did push for increasing, I believe that, by about $10 to $75 a barrel as a result of the current crisis. So there is a recognition that the current crisis does have an impact on Nigeria's fiscal position. But the other thing that must be said before I focus on corporates and the indigenous companies is ordinarily, all things being equal, part of what that windfall revenue is meant to allow the government to do is to make maybe 3 or 4 types of intervention. So the kind of intervention that targets is the people at the bottom of the pyramid, right? Then the kind of intervention that's more focused on long-term infrastructure development, right? So you build your roads, your bridges, and whatnot. And then other interventions that focus on giving you that flexibility to make future decisions. But we also have to recognize that we're in a pre-election cycle. So the question is, if we're able to capture that windfall fully, how do we deploy it, given the constraints around our fiscal space, without also triggering other macroeconomic consequences, especially spending and inflation? Now, when I focus on the indigenous companies or oil and gas companies generally, if you look at those who are in the deep offshore, who are under production sharing contracts and whatnot, the increased revenues that come in under the current fiscal structure, even with the PIA, actually increase the government share, right? So that's a factor. Now, for indigenous companies and local companies, it's a great time to really ramp up that investment, because right now your financial models are looking great and they're looking fantastic. And so your upside scenarios are more interesting. You can leverage that. But the caution that has to be advised there is really around the fact that now many companies, there are lots of deals floating around, for those of you who follow Nigerian oil and gas, is really thinking about leverage and your capital structure. So one of the things I do in an advisory capacity is I co-manage a fund that invests equity in upstream oil and gas. And one of the opportunities I'm seeing is that all these borrowers are going on there to leverage their financing and acquiring all these assets. And if you don't building that level of flexibility, then it can be a very dangerous space. But on paper, across board, it's a fantastic market for an upstream oil and gas producer. And I think the private sector is more likely to translate that into gains, perhaps, than the political or public space is likely to do.
Thank you. Thank you very much. So in other words, ensure that even though, yes, we can see the upside, it's not just to have an upside, it has to be structured. It has to be structured that brings out the relevant value. Perhaps we look at, on the government side, we can hope that that value is somehow translated to not just an increased federation accounts, but also value for Nigerians, perhaps. And then also on the private sector as well, even though there is that increase, let us ensure that structures are also put in place and people are not necessarily just rushing into big decisions, and probably also have a cautious approach as well in how things are being done. Yeah. Thank you very much for nicely putting that together. But we want to hope that this US-Iran war is temporary, because I know that we said that with Russia, Ukraine, and we're still here. But because of the inflationary pressures and global economic shocks that this is really causing across the world, we're really hoping that at some point this will stop. Let's go to the second round of questions. And I think this is a question for you, Maywa. For institutional investors and equity research teams that obviously cover frontier markets like you, how do you then build the analytical discipline to distinguish between a temporary volatility spike from a structural market shift that then demands an immediate repositioning of strategy?
That's a very interesting question. So I think if one looks at Nigeria, one can maybe use that as an analogy of how, as an investor, you have to start looking at things differently. So the equity market, or should I say the Nigeria economy as a whole, under the previous central bank and government. So if one thinks of Nigeria from 2014 or 2015 up until 2023, you had a situation whereby, I'll say there was extreme regulatory risk, whereby the central bank pretty much discouraged competition to a reasonable extent, determined banks' profitability. So you had central bank control reserves, so cash reserving, deciding how much the rate was. As a bank treasurer, you really couldn't plan your liquidity because the central bank decided what to take out of your of your balance sheet. And then as a business as well, a manufacturing company, you struggle to plan your how to acquire your raw materials, for example, with the volatility in the currency and lack of limited liquidity in the currency as well. And so how you looked at Nigeria and value Nigeria from an equity premium perspective will be different from now. And so if you're looking at the Nigerian environment now and how to operate in that environment now, it's difficult to use the lens of the, should I say, the 9 years with Godwin Emefiele as central bank governor. If you're a banker, for example, if you wanted to invest in the banking sector. And so I think trying to understand what is temporary. So if you look at the levers that have changed in Nigeria, I would say beyond having a central bank that is now pushing for a more orthodox way to manage the banking sector from the unorthodox period. I think if it's clear that that has changed, for example, then you have to look at things differently and expect that premium there and see that maybe the improvement in valuation isn't necessarily a bubble, but acknowledgement of change in the environment and appreciation of easier way of doing business. So I think if one looks at it from that point of view, they may be easier to separate what is temporary to what is a bit more permanent, because I think it's also difficult to argue that we would have this environment for a long term and determine how you define that long term. With a new administration, one could have a shift as well. And so that's how I would say one looks at this. And to your point of Ukraine, Iran, Ukraine, Russia, we're still going on, but the world seems to have moved past the price of grain or the restriction or embargo on crude. And so, yeah.
When he said survive, stabilize, and then we restart growing again.
Yeah. So even with this as well, you can tell that the market is looking for good news beyond this war. And I suspect at some point, the market will figure out a way of moving past Trump's tweets as well and know what's real. The operators in that environment will figure out how to operate in this new environment as well. And it might mean a case of oil becoming too expensive, that alternatives start becoming that better option as well. So I think it's trying to figure out what's temporary, what's different, and between that, understanding and trying to model that in that decision making.
Thank you very much for sharing. And let me come to you, Arnold. I think the question to also ask as well is where you have a situation, particularly in Nigeria as a frontier market, where you see that dollar liquidity can evaporate almost overnight, and then as Dr. David talked about buffers, right? And where we then see that local currency buffers offer limited protection. What does genuine financial resilience look like for institutions and corporates that then operate across multiple African markets simultaneously?
Oh, wow. Geez, I think everyone has that question, including me. Okay, where do I start from? So I recently started reading this book by an economist called Joe Studwell, How Africa Works. I bought this book months ago. It took me a while to read it because I didn't want to be sad, right? And I picked it up 2 weeks ago, and I just decided to finally read this thing. And he boils Africa's problem down to three things. He simplifies it down. He says one of them is when the colonizers came, Africa was built around low. Africa has, in fact, in general, right now, Africa has low population density. And the second one, he talks about Africa being an extraction zone, right? I hate saying this because it hurts me to say it, but it's almost like we were never built to trade with ourselves, right? Because you talk about multi-African countries, and it's the fact that we were never built to trade with ourselves. We're just built to take our resources out, whether it's the revenue that you make and whatever you can take out, and then the third one is because everything was taken out, nothing was invested back in, right? So I'll answer your question based on the extraction perspective and as Pan-African portfolio manager, because I manage Pan-African portfolios. And selfishly speaking, what I do is I house these portfolios in Mauritius because I know that there are no currency controls, right? And I have a global custody in Mauritius who then has local custodians down. And then I have clients that I have to pay and settle across the continent too. I've tried PAPS. I don't know if anyone has for cross-border. And it's just been a conversation back and forth. It's stop with the central bank. Central banks give banks allocation, and one person's allocation isn't enough to do anything. So my answer for you is the selfish thing that I do. But one thing that I can say is I constantly have conversations with local bank treasury desks, right, to find a way around this. For financial resilience is understanding that the currencies are volatile and having hedges in place with our currencies, right? I'm a huge speculator, so I can still answer as a speculator. I'm doing carry trades in Egypt, but I'm speaking to treasury desks in Egypt. The only way I can think of is constant conversation with treasuries and constant conversation with central banks, trying to figure out how to then put everything back in to build a system that works. I'm not privileged enough to use cross-border payments like other people are. Maybe I don't want to say my size, but it's just perhaps the things that I have to do and the instruments that I have to use. So for me, that's just how I build financial resilience. And it's just to make sure that my custody, or my main custody, is in a place that I will not see any FX controls anytime soon. And just constant conversations with banks and treasuries.
Thank you very much for sharing that interesting perspective. I think, Brother, let me come to you. In energy and infrastructure, where capital investments are updated, project timelines are spanning multiple political and commodity cycles, how do finance leaders build decision-making frameworks that remain coherent or relevant when the worst-case scenario was never on the original research?
Okay, it's a jam question. Before I come to that, I wanted to just quickly make a comment on something you said when you asked in the question of how do you know this is just a temporary spike or a new normal. Yeah, so if I bring that example to the industry I work on, which is mostly oil and gas and energy, I remember there was a huge debate at the start as to whether, in terms of financial modeling for oil and gas, whether we start to change the oil price assumptions for the base case. And this argument went back and forth, and my view was that stick to the $60 or whatever we've always used, but then the price spike is just a geopolitical premium, and that's just upside. But actually now, the crisis has also changed some things fundamentally in the market. And one of the ways I'm finding you start to know whether this is temporary is whether a crisis forces markets to become numb to reacting to certain things. So I'll give you an example. There was a time as an oil and gas analyst is when you're trying to make sense of market fundamentals, geopolitical risk, supply dynamics, US dollar policy, monetary policy, clear signals that tell you where we're likely to head. But because we've had all these sort of headwinds and black swan events, because there was COVID, then we had Russia, Ukraine, now we're here, it's actually forced a structural shift to what people call normal. And then the second thing is, which is a phenomenon in the oil and gas sector, is when you look at what it takes to either ramp up production or get production back to previous levels, it's not going to be just an easy, you just don't open the floodgates and we're back to where we are. It's actually going to take time. And that time for some companies or that have shut down maybe a couple of years, depending on the frontier. So that's how I think about it. I think there's a new normal that this crisis is going to bring. And I know Samson is someone who's very passionate about. I remember this debate we had on a Nairametrics panel where he talked about he feels we're never going to go back to $60, $65 oil. That debate caused a lot of controversy, but I'm sure you'll hear from it. But so that I just wanted to contribute that. Coming to the issue of energy and infrastructure, I think one of the challenges we face in our industry, because we're typically getting long-term loans. Energy, oil, and gas is different from infrastructure. Infrastructure is usually long-term local currency, right, finance, 15, 20 years. If you're looking at oil and gas, depending on whether it's production, development, wherever you are, 5, 6, 7 years, 4 years. The mistake I think a lot of companies make in their decision framework is restricting themselves. So if you look at a company that has borrowed and has very little headroom, and it's entered the situation where it has really tight and restrictive covenants, right? When there is now a downturn, it cannot react. And so a lot of times those oil and gas companies are spending so much time just trying not to breach covenants. They can't even go in and borrow additionally because they've restricted themselves so much. So I think the decision-making framework needs to really look at how you build a flexible capital structure that allows you to take advantage of new financing sources. And then the second point around decision-making is we spend a lot of time thinking about risks in a very linear, so oil price will move, something will happen in Iran, this and that. The bigger issue, I think, in this market is our assumptions. So what would happen if this particular assumption doesn't hold? And I think if we start to frame our decision-making around that, it actually prepares us to deal with those headwinds better. And then the third thing and final thing I would say on this question is really around the fact that there was an era, particularly maybe in more Western advanced economies, where many managers and financiers were used to the cheap money era. Right? If you think about it, at one point, 0 interest rates, in Japan, negative interest rates. So many people have actually not understood the project cycle in an era where you're now facing tighter conditions, right? So your ability to adapt to that cycle is something that is key. So it's really about changing the way you look at your approach decision-making from a risk versus assumptions perspective, and ensuring that you build flexibility, your capital structure that allows you to tap into alternative sources of funding for your energy and infrastructure projects. I hope that helps.
Yeah,
Thank you.
Thank you very much, Frankie. I'm going to come to you, NOLT. How should finance leaders prepare for a fundamental shift in cross-border sensitive infrastructure across Africa? I know you said you were not friends with PAPs, right? But I don't know how you are going to speak to this one, particularly now that the question does require you to speak a little around cross-border infrastructures. And so, are you going to think about it differently? What do you think about, perhaps, are you seeing an end of USD dominance? Is it possible? What are your thoughts on that?
I just want to correct. I'm not saying I'm not friends with PAPs before they come after me. A few years ago, I went through a short period of trying to make PAPs a personal mission. And I did reach out to Frexim and the guys at PAPs in Egypt and tried to work with them. But it was a passion that lasted, for a few months. But so I am friends with PAPs, and I think that I like the idea of it, right? I do think that it's an opportunity to get Africa to trade with itself. Yes. Technically speaking and practically speaking is hard, right? Because Naira is priced in dollars, CD is priced in dollars, Egyptian pounds are priced in dollars, if you know what I mean, right? So dollar is the base currency. And the whole concept of PAPs is, if you're in Ghana and I'm in Kenya, I can send you CDs or shillings. Without that translation, that's the vision that I think they have, or that's the vision that I have through PAPs. So how can we prepare? You can reach out to them, right? You can go to their website, you can give them a call and say, listen, I want to do this, I want to have a call with you. And this was 4 years ago. They seemed very happy to have a conversation, and I met with them in Ghana. So I'm just trying to say that, yes, I'm friends with PAPs, so I don't want them to come after me. But that's one way we can do it, right? Is we can figure out how to make this thing work for us. We can try and work with Afrexim and PAPs to figure out a structure that works. Is this the end of dollar dominance? I wish, right? if you look at my investment book is shaped like it's the end of the dollar dominance, right? I'm extremely short dollars. I'm very long gold, right? I do think that in a few years, I do think that central banks since 2022 have been reducing the dollar dependence and increasing gold, right? I think that as this war continues, you're going to see more countries try and keep their currency in-house and not buy USD assets or just reduce their reliance on dollar. But I don't think that's... There's a part of me that also doesn't think it happens in my lifetime where where dollar is not dominant because everything is priced in dollars and it's going to take a lot of shifts. Maybe a few more wars, I don't know. But what we can do is figure out how to make PAPS work for us. And we also have cross-border payment platforms that allow seamless payments. I normally talk about EcoBank. Have this payment system that if I was in Ghana and you had an EcoBank account in Kenya, I can send you. For some reason, we don't have it here with Naira EcoBank, but when I lived in Ghana, I could send shillings from my EcoBank account to another EcoBank. I think that's a wonderful platform that should be built on. I don't know why they're not building on that. I've always said EcoBank should just remove the bank and just, and just get the payment system separate. So there are systems that allow you to do this. But how finance leaders and business leaders can do this is to figure out how to work with PAPS, how to lobby our central banks around the continent, because PAPS is a central bank. It's an Afrexim central bank platform, right? And we need to allow, and it's supposed to work for traders, especially informal traders, right? So we need to figure out how to lobby these central banks and how to work closely with the likes of PAPS to actually get cross-border payments working.
Yeah, thank you. Thank you very much. And maybe we will also have some old fintechs. We'll also come up with some kind of innovation and technology that will also help, these sorts of applications. Thank you. Thank you very much. Meanwhile, let me just ask you the last question. For everybody else, answer this round of questions. I'd just like to get closing statements so we wrap up the panel. And for me, the question is, traditional financial models, when they're being built, many times focusing on one bank, one country, one asset, and many times they're failing to capture systemic risk in frontier markets, especially risk that's spreading through regional banking leakages, sovereign debt problems, cross-border capital flows. And so the question to ask, therefore, is how the regional banking exposures, sovereign debt contagion, and cross-border capital flows create systemic risks that standard single entity financial models consistently fail to address.
That's
It's a strong question.
Yeah, it's a very strong one. And so I don't know who invested in Ghana a couple of years ago, the Eurobond, and I'm not sure how many were attracted to the almost 50+% debt rate on their local debt as well. And I think that's one, I would say, recent experience by Nigerian banks, for example, on contagion or impact of sovereign debt issues. And I think most Nigerian banks were lucky and were far away from Zambia and even Ethiopia and the issues they had there. But I think with Ghana, it was closer to home. I think fortunately, because for most of the Nigerian banks, they still have a higher concentration, if you look at their balance sheet, more in Nigeria than in Ghana, for example. So the impact wasn't as negative or as significant. But I think it raised that question of, and maybe it raised the view on, I think even for the Ghanaians as well, that sovereign debt is not risk-free. And so for a long time, you assume you can always print your local currency. So it almost doesn't make any sense defaulting on that local currency. But we saw that with Ghana. I think there's already concerns with Senegal as well, because they have some issues with their debt there. And there's been questions of, for Nigeria, what kind of exposure do Nigerian banks have? And I think fortunately it's very minimal if there's any at all. And so I think that experience has increased concerns and questions. And so as a bank, for example, whilst investing across regions, I think the regulator and how the regulator pushes for sovereign exposure and limits those exposure, I think it's quite critical. So if I look at our own experience at Standard Bank, and so even though we're present in Nigeria and have a dominant business in Nigeria, there's always also a limit to how much exposure you can have to the sovereign just because of this kind of risk. So I think capturing and understanding those, and I think beyond sovereign risk as well, there are other sectors. So if one looks at Nigeria with, I think when there was a subsidy crisis and subsidy was removed, there was clearly that issue with exposure to the downstream oil and gas sector. And so even quite recently, with the emergence of the Dangote refinery, exposures to those independents have created some issues. Power sector loans as well in Nigeria have been challenged in the past. In Ghana, the power sector as well had created some issues. So I think understanding, particularly if you're an institution that has exposure across businesses, across regions, capturing most of those risks and limiting exposure and having some disciplined way of managing your exposure, I'd say, reduces some of these risks when they emerge, because if they will, but if you manage your exposure reasonably and have enough buffers to absorb and absorb those risks, then it's easier to survive when one and go through those risks when that happens.
Thank you very much. I guess you can't just really just have tunnel vision relations with some things. You have to ensure that you are ensuring that you're looking at all of these other issues that may affect this. So whether you're looking at sovereign debts, whether you're looking at regional banking leakages, everything in fact does impact and cause systemic risk. And at the end of the day, you have to price these things into your model and not just look at this from a one channel perspective. Thank you very much. Last question for you, Malake. As African energy companies look beyond development finance institutions for capital, what does the path to securing funding on an international level actually look like? And are we on the verge of seeing more deal activity and sectoral diversification in African energy finance?
Okay. I think African energy finance is a very broad spectrum, so, and the funding structures are different. So I'll speak just very briefly to maybe oil and gas and maybe a bit of alternative energy. I think the biggest shift, which has shifted the landscape, is obviously the divestments and the focus of IOCs on offshore. So with that, you've seen international balance sheets with African, which IOCs typically relied on, that's not available. And then even the project financing that we typically saw, much tighter conditions. And then you had a situation where, for those in joint ventures with NNPC of old in quote, those cash call obligations weren't materializing. So you face this gap now, and the question is, who's going to finance the new generation of indigenous oil and gas companies? My personal view, right, short of going to international oil traders who can do maybe sort of junior or subordinated debt structures, and in some cases take equity for offtake, is I'm a big believer in the power of domestic institutional capital to do this work. And why do I say that? I think domestic institutional capital, I'm talking about pension funds and maybe life insurance companies, actually have appetite for oil and gas, because today, many of them are exposed via equities to your Seplat, to your Aradels. Even though we know, and maybe Oando, I'm not sure, to a lesser extent, but what they're looking for is a vehicle and a structure that allows them to make those investments in a way that makes sense, right? Which is why I'm also working on this, what will ultimately be a listed closed-end fund that will plow equity into upstream oil and gas producing cash generative assets. And I think that is a space because right now they're underexposed. So less than 1% of all their assets go into. So I think that is something to look at. I also think the onus is on the operators and the indigenous companies to build more interesting structures where, for instance, on an upstream oil and gas project, you can then match that with a midstream infrastructure project tied to some sort of long-term cash flows that brings in a bit more development type capital because, you know, they might be interested in infrastructure play. And then leveraging all these new types of relationships for barrels. On the alternative energy side, honestly, there is a lot of activity going there. I can talk about DARS, I can talk about Mission 300. That space is no longer just the preserve or philanthropic or grant or impact funds. We're now seeing more commercially viable structures, especially because subsectors like solar are now pivoting away from purely residential to commercial and industrial, right? And I think you have more credit-worthy off-takers in that segment, which would then allow the industry to attract capital into that segment. And then finally is really the type of capital that you require to come into gas infrastructure processing the midstream. And I think, again, we're seeing some commercial bank activity, but we're also seeing new institutional investor bases who are taking an interest in that. So I guess the bottom line here is that the funding mix is changing and evolving. We will need to source capital. For today, I can put a figure on how much of the barrels that have changed hands from IOCs to international companies. So we have, over the last 2 or 3 years, around 500,000 barrels of production has shifted from energy companies. And just to maintain production at that level, the total level we're at, the do-nothing scenario, you're going to need at least, and we've done this exercise, $25 to $30 billion. That's not adding incremental capital. So I think there's a huge opportunity here for domestic institutional capital. It's good to see that PENCOM is becoming a bit more amenable to having the conversations. But the challenge there is how they think about liquidity. So actually having the right structures that allow long-term domestic capital to plow into these assets and then maybe then take those assets in a fund structure to public capital markets that then at least gives liquidity, even though the underlying asset may not be immediately liquid, but at least introduces some liquidity, which is what domestic institutional capital like, regular distributions, right? So I think that's kind of what we'll see. So I'm very bullish about the space, and I just think operators also need more innovative structures in terms of their projects.
Thank you very much. I see that Blessing is giving me the eye, so at this point, let me pause and ask if there are any questions from the audience. Anyone have any question? We will take one question because of timing. Very good. Fantastic. So I think that our panelists have done an extremely great job. Can we please clap for our panelists? The message is very clear from the conversations today, whether from an asset management perspective, from an equity research perspective, or whether from an oil and gas perspective. You can extract value from volatility. Financial leaders are going to have to ensure that they are dynamic, whether from a structural perspective, whether even from an operational perspective. But it's not easy because there's volatility. Volatility these days seems like it's now the baseline. It's no longer an exception. And we will see that it will happen from time to time. But we just need to be resilient. Thank you so much to my esteemed panelists for all their contributions and perspectives. Please let's clap for them again.
Please make welcome Sheyi Bella, a partner and head of banking and finance practice, Bongo Ighodalo. If you enjoyed the first panel session, I can guarantee you that you will enjoy this even much more. And very quickly, she will be welcoming and introducing her panelists, and we'll dive straight into it. Please, I'd like to remind you, if you're outside, do also find your way into the hall because we have started.
I'm just going to go right to it and introduce my distinguished panelists. I'll start first of all with Olaobo Alabi. He's the Executive Director, Real Estate, Assets, Cardinal Stone, an investment professional with 16 years across private equity, real assets, and public equities. Olaobo leads real estate investment strategy and serves as fund manager for the Cardinal Stone Real Assets REIT. He previously led real estate and private equity investments at African Capital Alliance, managing and exiting a portfolio valued at over $80 million. A fellow of the ACCA, he holds an MSc in Finance and Management from Cranfield School of Management in the UK. Can we please give Olaobo Alabi a resounding applause? Our next panelist is Samson Esemwede, CFA. He's the Managing Director and Chief Investment Officer of ZROSC Investment Management. Samson oversees investment strategy and portfolio management at ZROSC, bringing experience from vice president roles at Deutsche Bank and Citibank across global and emerging markets. He holds a first-class degree in biochemistry from University College London and a CFA designation, combining scientific discipline with institutional investment expertise. He's also an active investor in Africa's tech ecosystem, having backed high-growth ventures including Lemfi and Vector. Please, can we give a resounding applause for Samson Esemwede. And the wonderful and the beautiful female on this panel. No other person than one of my directors at NOLT Finance, Dolapomi Onamida. She's the Vice President Business Development at Flutterwave. She's a senior fintech executive with 16 years at the intersection of banking infrastructure and technology. Dolapomi drives commercial strategy at Flutterwave, Africa's most valuable fintech. She built her foundations at Zenith Bank, UBA Group, and Stanbic IBTC before pivoting into fintech leadership, where she specializes in cross-border payments and enterprise partnerships. She holds an MSc in International Public Policy from University College London. Can we please give her a resounding applause? Thank you very much. And good morning again, or afternoon, to my esteemed panelists. We're just going to go right to it and start the conversations. Of course, we know the conversations today, we talked about how we extract value from volatility and how we ensure that we can be strategic even in uncertain times as we find ourselves. And so I'm going to start first of all with your good self. But you have a background, of course, real estate funds, private equity funds. The question for us, and we'd like to ask you, when we look at opportunistic funds, and what are opportunistic funds? Let's go look at that very well. Of course, these are funds, of course, that have finite lives and fixed return expectations. And of course, investment vehicles that target high risk, high return situations. And the question, therefore, is, with opportunistic funds that have finite lives and fixed return expectations, when market conditions turn, how do you make the call to restructure a position before you are forced to, without signaling distress to your limited partners or undermining the asset's long-term value?
Thank you. Sorry, I'll start with the minor difference. So opportunistic funds, again, just to recap the definition, is at the highest point of the risk reward. So your expectation is that you are able to get very attractive returns, but you're also taking risks. And these are funds that are very often open to institutional investors, not so much retail investors. What we've seen is that this is an industry that has been supported majorly by development finance institutions, so the CDCs and OPIC, DFC. have been main proponents, and they've taken a Pan-African exposure. So, and that's why you find that a lot of private equity funds are also of a Pan-African nature, trying to capture multiple markets. What we've seen is through the macro cycles. So even if we zoom past the last couple of years, as far back as 2008, 2010, there was a lot of positive enthusiasm for the sector. There was the phrase in private equity circles where we said Africa rising. And what that just meant was a lot of the macro indicators were trending in the right direction. And now in the morning session, we've heard that what has happened or what is happening is anything but. It's a lot of volatility. But even before that, to answer your questions, what volatility does to your business case is it delays the time it takes for you to realize the expected performance. The nature of private or alternative investment is you give money, it's not traded in stock market, so there isn't too much volatility. But at least in Nigeria and Africa, what we try to execute is growth capital. So the idea is that this is money that you use to grow your balance sheet, grow your operations, and eventually be able to exit by way of IPO or a trade sale. And so what that then means is if you're not meeting your targets, then institutional funds that typically have a 10-year life cycle are not able to exit in that sort of time frame. And so you found that, to answer your question, one of the things that has helped or has actually just evolved naturally is investors, which is the GPs, have had to have very honest conversations with your limited partners. There's always pressure for the limited partners to say, please return my money. I've given you money, it's 10 years, give it back. But there are two scenarios. One where the macro indicators has pushed out the delivery time for the performance, or one where it's fully distressed. And I think that is sort of where GPs typically try to earn their fees, is to make sure that you're not in the second bucket, you're more in the first. But then in terms of also fund structures, we've seen an evolution where, as opposed to the typical finite life funds, a lot of funds are considering permanent capital vehicles. And that just means that, well, you continue to, there isn't a time frame. The expectation is you're still able to deliver risk-adjusted return over an extended period. But the removal of that pressure has now allowed investors to continue to think. Now, not everybody has that luxury. Not every investor has the luxury to do that.
Yeah, thank you very much. I think that's a very interesting perspective, and I'm glad to see that there are actually funds that are taking a long-term view. Because most times we see companies are under a lot of pressure to try and attain certain targets that are just impossible because of market conditions. So thank you very much for that perspective. Sansa, let me come to you. Everybody has talked about this US and Israeli war on Iran, right? And the question is really, other people are fighting, yet we're suffering. Because they say when two elephants are fighting, it's the ground. And whether we can say it's two elephants now. But I think what is happening is
Iran
exactly. Small Iran is now going to be a big elephant. But then yes, in someone else's war and some problem. Geopolitical conflict is definitely disrupting prices, shipping costs have risen, dollar liquidity also impacted. What does a genuinely strategic financial response look like? An alternative investment manager operating across African markets beyond just waiting for conditions to normalize. Yeah.
So I think the first thing I would say is when you're operating in a place like Africa, I think volatility is your base case. All right, and volatility is not a tail risk.
Yeah.
Right. So when you are structuring products and you're structuring funds, you have to take into account that what are we trying to do on the continent? Like for me, I'm trying to be long convexity at the cheapest possible price.
Yeah.
What does that mean? Is I'm looking for asymmetric payoff profiles without paying the big premiums on them. That's how like the entirety of the business is structured. So inherent in that business is a long volatility position, right? And then you also need flexibility around being able to deal with macro regimes that are evolving, right? A lot of frameworks and systems and heuristics that we learn in finance schools and investment banking divisions abroad they don't necessarily apply here. Not necessarily because they are not true. It's just that the assumptions that are underneath those frameworks don't necessarily apply in this market. So you need to build what I call an anti-fragile investment system. So what does that mean? At Rust, we basically have a macro overlay around what we do. So all of our asset allocations are kind of fitted into what is the governing macro regime, and we set the macro regime on a periodic basis across liquidity, across FX, across all the macro parameters, balance of payment, etc. That macro regime defines our asset allocation. So within this context, when you really think about what has happened in the Middle East, you've had a significant supply chain shock at a time where for Nigeria, the energy intensity of the economy has gone up because of the liberalization. So the second order effect of that was a massive translation into inflation. And you're starting to see core inflation build up across the entire economy. And then there's also the lag effect of food, and you're starting to see that in rural food data coming through. So within that context, what do? You build portfolios. Like for the portfolios that we run in the listed equity space, right? We have very, very liquid positions, right? I have a target from a risk management perspective that I need to be able to exit 80% of my portfolio within a 20-day trading window. And I test it for 30% ADTV and 10% ADTV just to ensure that I have that level of flexibility. So when February 28th happened, we had our next IC emergency. The right approach was, listen, the macro regime is shifted. The base case that we had was a level of disinflation, real rates compressing, asset multiples going up, and obviously also means that weaker balance sheet would thrive within that macro regime. And our portfolio was structured to capture that, right? And then by February 18, we're like, okay, this macro regime doesn't exist anymore. The base case is we need to unwind. So we run very concentrated portfolios. I cut my portfolio position from 12 stocks to 8 stocks, and went long oil and gas, went long banking, strong balance sheets, and basically tripled my cash position overnight to give me flexibility. That is anti-fragility. It's the ability for you to shift and change positions. Obviously, within the listed space, you can do that. Within the non-listed space, it's a bit more challenging, which is why you need to then look at your investment across the macro cycles in which you are investing. There are certain types of businesses that will benefit from long-run disinflation, and certain types of businesses that will benefit from high level of cash rates. So when you are funding deep J curve in a high interest rate environment, and you don't have the balance sheet to support it, you just know you're just going to face trouble at the end of the day. But if you are thinking Africa, we are structurally a high rate regime because of the supply side issues we have around inflation. What you then think about is, how do I ensure that I invest in companies that may not necessarily be billion-dollar companies or unicorns? The J curve has fixed, the time scale to cash flow break-even is rapid, and I can, because once you start to make cash, high rates is actually good for you, right? So it's like, it's how you structure that. So our non-listed portfolio is structured around macro awareness, regime awareness, and the cycles that we are on, and those are more long run. And then in the short end of the liquidity spectrum, where we have the equity book, we stay relatively liquid, we don't take liquid risk, and we're able to adjust the portfolios for macro regime that we're operating around. But yes, you're right, there's nothing, it's really sad because I think we've done the hard work of reforms, and we were starting to see the green shoots of those reforms, and for no fault of ours whatsoever, that has now been delayed. I don't think it has been impaired, but I think this inflation has probably been pushed out. It's likely that the CBN would need to tighten rates, because if you look at March inflation month on month is 4% annualized, that's about 50%. So I think we might exit this at 20% inflation for this year if that trend continues. And within that context, then I think for a CBN that has anchored its entire credibility around inflation targeting, they don't have a choice. They'll have to get rates higher, either headline level or stealthily. I think because of the elections, they'll probably do stealth. And so we have to operate within that macro reality. And I always say, you can always make money if you understand the macro regime. And that's how we think about asset allocation.
Thank you very much. I need to come and take a next step on how we can also do all this risk adjustment and moving and flowing with the macros as well. But what I can say basically is ensure that even in structuring your initial models, that you've already baked enough flexibility and headroom to be able to allow for easy adjustments even when this volatility circumstances take place basically. So thank you very much for sharing on that. Don, we are going to come to you. Yes, we know that digital payment infrastructure is democratizing the way payments are made and also expanding financial inclusion in Nigeria. So as digital payment infrastructure becomes central to how businesses move and protect money, how are fintech-enabled treasury functions changing the speed and quality of financial decision-making during periods of volatility?
So I'll say today, or let's say yesterday, Treasury used to be like a back office function. Okay, so yesterday or back then, Treasury was a back office function, right? However, what we've seen today is that it is more of a front office war room where speed is absolutely important. Today, a company sitting in Nigeria is able to look at a consolidated view of your bank accounts across the world because you have fintechs that enable that to happen. I would double down to Nigeria, where through the acquisition of Mono, Flutterwave is also able to provide you with a consolidated view of all of your bank balances in Nigeria. It means that CFOs are able to make informed and very quick, very sharp decisions based on that data that they have. Another thing that we've seen is the rise in stablecoin rails, rise in programmable payments as well. We've seen that CFOs are also able to sort of put like a volatility threshold on their accounts to say that, oh, once my account hits this particular threshold, I'm able to move funds and settle with stables. What we've seen with stables, obviously, is one-to-one with the US dollar. So as soon as you debit your Nigeria account, or I would say not debit because you've already put that threshold in your account, so it's an auto sweep out of your Nigerian balance into your USD or your stables account. Stables is also immediate settlement, which means that you're not going to have to wait for one correspondence bank to give you the go ahead to do something. You literally debit your NGN account and then you can settle your stables immediately. In periods of volatility, these are the sort of things that you need for your business to move forward.
Thank you very much. So we see very clearly how the ability to be able to have real-time information basically is helping you make granular decisions that then help you with speed and quality from a business perspective. Thank you very much. Back to you. I have an interesting question as it relates to private credit and private credit actually. So private credits, the question you have is, so is private credit here to see? In markets like Nigeria, across Africa, do you believe private credit will become a core pillar of financing? Or do you think traditional banking will be a set dominance all the time?
I'll answer that question by starting looking at maybe the US market. The US market, the size of the US market for private credit, I think it was most recently reported at about $2 trillion. That's 2,000 billion, right? Just to put it in context. And interestingly, what we're seeing in that market is the early onset or signs of distress. And one of the metrics that is being measured is really around what the impact of the macro is having on the US credit. Now, why did I start with the US market? You have to understand how that country grew its private credit balance sheet, and the short answer is quantitative easing. So an extended period of low interest has allowed that market to grow. At least that's one of the answers to the question. Then when you come to Nigeria, especially from a private equity perspective, private credit has come mostly through mezzanine funds and also private equity vehicles that have that as a structuring. So as opposed to taking equity risk, maybe I'll issue a cumulative preference note into the investment. So I'm using that instrument as a downside protection. But if you simplify the conversation, I think the most important thing to say about that, especially for this conference, is that Nigeria has a huge funding gap. there was an institution that reported it at the funding gap for SMEs at somewhere around 48 trillion naira. And that translates to about 30 billion. Now, that then comes to about 2% of the size of the US market. And you must consider that you shouldn't even compare Nigeria and US, but it gives you a sense of the relative proportions. And why I say, so the answer to your question is private credit amongst other alternatives will continue to be around in the market. The way I like to talk about it is, look, banking is focused on the lower end of the curve. So when you look at consumption and savings, and then private credit typically goes to the upper end of the curve. So they're taking higher risk, expecting higher returns, and usually they need it to be investment capital. So I don't look at them as opposites, I look at them as complementary in terms of the whole value chain. Now, the reason I started with the US market is because private credit is great, but it's also, again, the whole context of this conference is we're saying that we're in a volatile world. And what happened? What's happening in the US is that there's been a proliferation of credit, and not all credit is at a good level of quality. And so I think that's always the advice you'll give to any business or any lender or anybody that's trying to invest in private credit is you have to understand your risk. You have to be very conservative in the sort of risk profile. One of the things we've learned at NOLT is the importance of knowing your customer. And by that, we're not talking about the forms you fill. It's about the credit cycle. It's about building a business together and not starting at the very top in terms of the sort of exposures you take with client. Because if we say that volatility is here to stay, then we must then always embrace a position or a mantra of sustainable, being very mindful, as Sam and all the other speakers have talked about. But yes, I think for sure it's the size of the market when you talk about 48 trillion, and that's just SME. You find that the banking sector alone will not be able to support, and so there will always be opportunities for that.
Thank you very much. In other words, the pie is large, funding gap is wide, and so there is space for everyone to comfortably in. But then again, everybody needs to come. Those who specifically are looking at privates need to be able to increase the risk very carefully so that they won't get burnt. Thank you very much. I think poverty is sensitive. And this is actually the last question, and I'm just happy to see that for everyone. IPOs. Everyone's talking about IPOs. And it's not like we're in the season where there are IPOs in Nigeria. Now everyone's talking about IPOs, of course. If I see IPO, you're probably going to talk about Dangote, and then say yes. Because of the IPOs from African corporates that we discussed for years, but rarely executed. How realistic do you think is Dangote Petroleum Refining's ambition to be amongst one of the first generally African companies to list across multiple international exchanges? Right? And what would success actually require in terms of governance, disclosure, and investor appetite?
Yeah, so sometimes on the continent, I think we always like to put the cart before the horse, right?
Tell me about it.
So you need to build infrastructure before you do this thing. What we have on the continent outside of South Africa, which I presume this is not going to be part of, right? There is no liquidity, there is no institutional infrastructure to be able to successfully absorb the scale of the IPO. I mean, I'm hearing rumors around 40 billion valuation. He's looking to sell 5% of the business. That's 2 billion. 2 billion is 3 trillion naira. I mean, you saw how long it was for the banks to even do the recapitalization exercise, which was like 4-point-something trillion or so, right? So to be able to aggregate that capital within an industry where you don't have the deep institutional capital pools, within the continent where you don't have it's a challenge. So you're relying on little retail and aggregating, and the risk around that is also you split liquidity. So it's interesting idea, it's interesting concept, and frankly, we need integrated markets on the continent. But you need to build the infrastructure and you need to build the institutional backbone that makes integrated markets possible. So you can go and list and nothing will stop you from applying to list and the regulators will allow you to list on the exchange, but you likely have very fragmented liquidity profile. You might have shares that are not fully fungible across the different exchanges, and you kind of defeat the purpose of the IPO. So can you do it? Absolutely. Would it be successful? I don't think, right? And this is me just thinking from the top of my head. I just don't think that outside of South Africa, we have the deep institutional capital pool that will be able to absorb 2 billion and make an IPO very, very, very successful. I would concentrate the effort on the largest market, which is Nigeria, right? And if people offshore want to be able to participate in the market, they can open brokerage accounts with Nigerian brokers to be able to do that. Fragmenting what is already a thin market, in my opinion, I don't see it as the right strategy to go to aggregate the pool of capital that you need when you don't have the underlying infrastructure to support it.
Thank you very much for that. The Nigerian payment infrastructure is complicated. Price swings to regulatory shifts and liquidity crunches across exposed sectors quickly. You've talked to us already about real-time and the benefits of having real-time data and what that can do for you as a business. But what agrees in platform architecture, the regulatory frameworks, and cross-border interoperability does the industry need to make the Nigerian fintech generally volatility proof? Sorry, big questions.
So I'm sure we can all agree that Nigeria doesn't have a payments problem anymore.
Yeah.
What we have is really a stability problem. What had happened is, I'm sure we thought we had reached the marks of our payments, money goes here and there, and then we came up with money points. And then OPay came. Before you finish buying something at any supermarket, they literally get over it.
Yeah.
So we're okay with our payments. What the issue is right now is stability of the platforms. Today we have a central switch. NIBS. If NIBS goes down today, or the biggest bank in Nigeria goes down today, businesses are not able to collect monies.
Yeah.
So what we're looking for, what we need, is a redundancy in our infrastructure to say that you have this central switch, but then you need a redundant switch as well, where there's an automatic failover when anything happens. Second thing I would say for businesses is regulatory passporting, right? I should be a business in Nigeria, and I'm already licensed in Nigeria, I'm vetted in Nigeria. I want to go to Kenya to, start to operate.
Yeah.
Why do I have to start the entire regulatory shenanigans all over again, right? The fact that I'm already licensed in Nigeria, it should give me some sort of fast track to be able to then, start my business in Nigeria. It then helps Nigerian businesses sort of diversify their risks across Africa, as opposed to just keeping all your risks in Africa, right? In Nigeria.
Yeah.
And I would say the third thing is the thing that Arnold had a problem with, which is PAPs.
Yeah.
Today, before you can do any business with another African country, or even with other countries, right, you have to use the USD as a benchmark.
Yeah.
If we are able to get PAPs working the way it's supposed to work, I should be a business in Nigeria. I want to pay my supplier in Ghana. You debit me NGN, and he's able to get Ghana cedis immediately. That is what PAPs is supposed to be. That is how it's supposed to work. Obviously, we know that all of the central banks, they're all on the table with it, but it's the execution, it's the speed that we haven't quite seen. And if we're able to solve for these three things, I believe that Nigerian businesses will be able to expand across Africa, ensure that they can do businesses and also spread their risks.
Thank you very, very much. I'm going to ask my panelists to just give let's say 10-second closing statements, basically. So now that comes here. What would you like the audience to do?
I'll say that credit is one of the most important backbones of an economy, and that is also underpinned by stable environment. So if we don't have the stability, it is important that you also take that position into your business planning. But I think it's important to talk about how credit can help you grow, and finding a good partner is essential to that.
Thank you very much.
I would say that for a business to really be volatility proof, yes, you need to focus on speed, settlement speed, which is obviously immediate settlement as opposed to T+1 settlements, which we're used to seeing in Nigeria. A business should be able to turn over their funds and be able to then buy from the suppliers before the rise in the effort, right? We need to focus on settlement speed. We need to focus on ensuring that PAPS works and also ensuring that we can, businesses can, have fast tracks in other countries across Africa once they want to expand into those countries.
Thank you very much. Samson?
We've spoken a lot about volatility, and I wanted to make something clear. Volatility is not risk, right? I think the problem is that a bunch of guys in Chicago trying to look for a numerical number to capture risk decided to choose volatility because you can use standard deviation to approximate it. The reality is that risk is the risk of permanent capital impairment. That's how we define risk as risk, right? So it's not volatility. So when people see volatility is how you make money. Volatility is why things can go up, right? So the idea around avoiding volatility, then you are not really prepared to be in this business. If that's what you are thinking about. If you want to avoid volatility, you go and buy US treasuries. Even that, you are not even avoiding volatility. So once you decide to be in financial service or you decide to be in business, you have to embrace volatility. You just need to ensure that you have processes and systems in place to ensure that in that volatility, the risk of permanent capital impairment is low, right? And how you're able to navigate it. So that's the only thing I want to say. So I'm not afraid of volatility. It's about preparedness in terms of volatility that you are ready to deal with, right? So like there's this thing about known unknowns and unknown unknowns, right? So you need to know all your known unknowns, right? So that you have your balance of probability allows you to capture that. So for example, I always tell my guys in my team, it's like we have to plan in probability distribution, but life happens in a linear function, right? So your range of possible outcome has to capture the volatility. And if you are lucky and the outcome that crystallizes is better than your range, you make a lot of money. So your planning has to be scenario-based. It cannot be static. We don't make static forecasts as risk. It's all scenario-driven. It's all distribution-driven. What are my tails? How do I manage my tail risk? How do I ensure that I'm in the mean? I'm in 95% of my observable reality. That's how we think about risk. So the point I want to make is volatility is not risk. Risk is the risk of permanent capital impairment. If you separate those two, I think you'll be able to approach risk management better.
Thank you very much. That was a nice masterclass. Thank you so much. Can we please give a round of applause? I think the message is very, very clear. Volatility is not risk, right? And also we have to tell ourselves that dynamic adaptation is what is relevant, not static planning. I also like the fact about ensuring that speed, adaptability, having real-time information is important to be able to create long-term value at the end of the day. And credit, let's not run away from credit. And all the risks that comes with it, let's manage it and ensure that we have stable environments. Thank you very much.
We want to appreciate you for coming, and very quickly we will be taking the closing remarks that will be given by the co-founder and the executive director, NOLT Finance. Please join me with a thunderous applause as I make welcome Mr. Robert Ijeri to be able to close the remarks.
Thank you very much, everybody. Thank you for your time. They say time is money, so let's take up any more viewers. I've been extremely generous today. This has been a very, very long journey. It might not seem like it, but the first time this came up was, I think, about 7-8 months ago. And initially we were talking about balloons and parties and whatnot. And as the MD touched on earlier today, I was not a fan of it. What he didn't actually tell you was that while I was still saying, let's look at it, let's circle back, he had not even come back with a committee that had been implemented. He had come up with the plan, he had told us what it was going to be, and this was beginning of the year. So this actually has been a long time coming. So I am so happy and so glad to see how many people showed up. We know that it's been well attended. A lot of people have left, but we actually are grateful for everybody that's still here. We are grateful for everybody that did come and had to run. We do understand and appreciate this is a working day, so to have actually dedicated this much time to us is a real something we really do appreciate. It has been very exciting conversations we have been able to have today. We thank the keynote speaker, Mr. Alberto Adedibe. We thank all our panelists. It's been fantastically curated. We of course thank Mrs. Bella, our moderator. We thank the host. Thank you very much. We thank all of you for your time. We thank our partners, we thank our clients, we thank all the stakeholders. Of course, we thank our board, who is still here, who have left. We thank everybody. It's also a closing remarks as much as it's a lot of thanks. I just want to say thank you because we're very appreciative of all that you have done today and all that you've sacrificed today. And of course, we thank the Liz team as well for listening to the MD and doing all of this behind my back and putting together a wonderful event. Thank you all and have a wonderful